Good morning from snowy Minnesota. I've been kind of watching a lot of news here. We've got a lot going on with like the rates and insurance going out there, just crushing affordability for people. So I wanted to touch a little bit on the rates. Everyone, not everyone, but a lot of people are expecting that rates are going to stay higher for longer, and we're going to see 7-8% interest rates all year long. I don't believe that's the case. I understand their logic with it. I've got a different set of logic, and some of it requires a little bit of faith. Because we have a lot of unknowns that are going to be happening, and I'm gonna make some calls on which direction those unknowns go. So right now the markets are betting that the 10-year Treasury is going higher. So the stock market and stuff isn't yielding the big returns it used to. So the betting markets are kind of showing that rates are going to stay longer. The 10-year, the 10-year is not directly tied to the rates, but the investment on where the money flows, they track very closely. So you can kind of gauge where the mortgage rates are going to go based on the 10-year Treasury. And right now we're looking at almost 7% rates. I think the average, according to one, is 6.93, and the other one is 7.24. I think 7.24 is probably more accurate for today's rates. The other one might be dated a little bit, a few days difference. So, and the 10-year is sitting right around 4.77%. So normally there's somewhere between 1.5% to 2% spread between the 10-year Treasury and the mortgage. And like they're not directly tied, but they track real close. And right now we're closer to that 2.5%, 2.47 I think is where it's sitting at today. So how we get to lower rates is that spread between the two is the banks put a little higher return on their investment, so to speak. So when they get nervous, they're going to increase that spread between the 10-year and the mortgage rates. They need a little bit more premium for the risk they feel, and bankers are very risk adverse. So right now they see a lot of turmoil in the markets. They see market shifting, so the confidence level is very low. There's a lot of doom out there in the market, so banks get nervous and they pull back, so that spread goes up. And I think that spread is going to come back down more in line to like 1.5%. So if we can get to that spread, I think we'll see rates, let's just call them, they're at 7% right now. So if we can pull that in, we start getting into the mid sixes. And then the other item that people are betting on is Trump taking office. That's a big unknown. There's a lot being talked about on that. And the fear out there is what he's proposing is inflationary. And really specifically what they're saying is if he implements those tariffs on all the Chinese imported goods, our costs of goods are going to go up and inflation's going to skyrocket and Armageddon, all chaos. I think there'll be tariffs coming out. I don't think it's going to hit like people are fearing it will. One is China, they're in tougher shape than people realize. They've got demographic issues. They've got manufacturing issues to support what they have, so they can't afford to not come to the table and negotiate. There are other markets out there that can be outsourced to. So, and manufacturing can be reshored on a lot of these goods and services. So some of it will be inflationary, but some of it will not be as inflationary as people are afraid of. So I think what's going to happen is this is all going to get kind of washed out in negotiations. Trump's a businessman. He does not want lack of trade. Trade is good for business, and I don't see him shutting everything down with tariffs. I think he's going to the table with strong negotiating skills, and it's all going to get negotiated out. So I don't think we're going to see that inflation that the market's pricing in right now. The market's very skittish, and they've, I think, overreacted to potential outcomes of these tariffs. That's my opinion. That's where the faith comes in. right? Because no one has a crystal ball. The markets don't. The pundits, the experts posting on YouTube. I'm not an expert on it, right? I'm not an economist or anything, but I don't see that being as inflationary as the markets are pricing into the market. So, hey, Schwain, how are you doing? Welcome aboard. So that's kind of my opinion on where the rates are going to go. The other thing that I think is going to push it into the low sixes, maybe even high fives, is this is another step of faith, is I believe the books are cooked. The job numbers are worse than what they're reporting right now, and I don't know if it's incompetence or intentional, but last year we saw massive revisions, and I think we're going to see those coming in too. So I think the jobs numbers are not as good as the last job posting. So I think the books are kind of cooked on that, and I think once those revisions hit, the Fed will have to make some adjustments on it, so the market's not as hot as it once was. And then the other thing that's going to happen is a lot of the numbers that were in those are their government jobs. And I did something here. Let me see if I can find that. Oh my gosh, I was so organized and had all my notes here, and then I just had too many windows open. Okay, so I did a little search here, and since 2020, pre-pandemic levels, government jobs increased by 1.175 million compared to 2020, with 709,000 added in 2023 alone. So almost, 750,000 jobs added in 2023. Most of these occurred at the state and local levels, while federal employees saw smaller increases. So then, if you're going to calculate that out, the unemployment rate for December was 4.1%, with 256,000 jobs added that month. If you took out all the government jobs that were added, just going back to the 2020 number, you'd be at like a 4.8 or 5% unemployment number. So a lot of those jobs I think are going to get removed from Doge, and then that's going to change how the Fed perceives how the economy is doing. Right, those jobs aren't really productive jobs. I think Doge is going to come in and clean house on a lot of that. Department of Government Efficiency. So that's an unknown. That's another leap of faith on what could happen when the Trump administration starts taking over. But I think that will rein in interest rates as well. And I think the markets have over-speculated on the cost of these tariffs. I think fear struck in, and they priced the rates temporarily high. So I think, I forget his name, an economist, he's very well known, very well respected. He's expecting rates to be just under 6, like 5.8 by the end of the year. Well, or 6 months, like the second quarter, or second half, sorry, not second quarter, second half of the year. And I think that's plausible, and I think that's kind of how he would get there. But it takes a leap of faith to say that some of these numbers are inaccurate, and then when they get readjusted out, and then when you take into account the impacts of Doge, and then you take into account that most of these tariffs are going to be negotiated out on the negotiation table, I think we're going to see those rates rein back in. So that's my prediction for 2025. Blinding optimism and denial, as I've been accused of that before too. So we'll see how it shakes out. I have been wrong before, so this wouldn't be the first time. So I'll share a little bit of screen here. So this is a 10-year Treasury I mentioned at 4.77. And then we're going to go to the next chart. Here is the 30-year fixed rate. This kind of tracks oh, that didn't track over, did it? Share this tab instead. Okay. That's going to track very similar, and right now, we shot up dramatically, so that freaked people out. Not as bad as in the early 80s. And Michael Zuber compares today's market to the 1980s. I don't think it's anywhere near as bad. The other thing that we had in the 1980s is this is when the boomers were hitting the workforce. So we had a lot of pressures in the economy here. We have the millennials, which is actually bigger than the boomer generation. So that's putting pressure on house prices. But I don't see this playing out in the job market as much because the boomers are retiring as the millennials are entering. So I don't think there's as much job pressure. They're having a hard time filling some positions because the millennials and the Gen Y don't want the same kind of work that the boomers were doing. So, and then where do we go from here? Real median household income. This one is I keep tracking this one. This is from the Fred database. So we have the green line here. So the green line is the M2 money supply, and you can see that track throughout time. And then we hit the recession. This was the Great Recession here. And then they just started printing money, quantitative easing, printing money. And then we come into COVID, and they print like 40% more money supply. Reined it in a little bit, it's climbing again. So the red line is S&P Case-Shiller index, and that's a lagging index. But back here during the housing bubble, you can see where that actually exceeded the M2 money supply. So that was a real bubble. And then the house prices have just been tracking M2. So I see house prices, if it has to go in line, my theory is it has to go in line with M2, right? It's so many dollars chasing the same goods and services. If you have, $1 in the marketplace and 2 loaves of bread, how much is a loaf of bread? If you have, $10 chasing 2 loaves of bread, how much does a loaf of bread cost? So that theory. So I believe these two lines are going to have to go back to their historic average back here real close together. So I think house prices are going to continue to close. Where the pain is and what's holding us back is getting this blue line. The blue line is the real median household income in the United States. And these are all indexed to the year 2000, which would equal 100. So they're moving in sync with each other. Just for comparison's sake. So that's an index that I put together for the Fred database. So the incomes would have to increase to get back to historical norms. You can see that the median household income was above the M2 and the Case-Shiller index, prior to 1990s. So that's why everyone hates the boomers, is because they think they had it really easy back here. And then that spread between the median income and the house prices and the inflation, that's why everyone's feeling the pain right now. Then you throw on the insurance problems with the housing, that adds to more unaffordability. And these California fires aren't going to help anything with all the billions and billions of dollars that have been lost there. I don't know how that plays out. California kind of screwed with their homeowners insurance. So I think a lot of that is through the states. So I don't know how that state's going to handle that if they go bankrupt and if the federal government comes in and tries to bail them out. I don't know. It's a real mess. So this one, I see nothing but house price pressure. There may be a short-term dip, but I don't think we're going to see any sort of crash like the boomers are calling for. And then this screen here, this is household inventory estimate. And this is from the U.S. Census Bureau, and then household estimates. These are kind of lagging data, but it kind of trend line over time. So you can see that the households are getting closer to the housing inventory. So that is the shortage of housing we're experiencing. Now, some markets overbuilt, like in Florida, you had some run up on speculation with the short-term rentals, and then a lot of builders hit the market, going to be first to the market with their new homes and their new subdivisions, and that happens. I think Robert Kiyosaki said those cranes of death. The vultures, those building cranes, you see them, they call them cranes of death because that's a sign that one of those developers is going to lose their building because they're going to be the last to the market and they're going to oversaturate the market. But when they started, the market needed it. It's just a race to get your product to the market. So I think some of those markets are oversupplied for the short run. But I think that demand with that population increase, the household increase, I should say, is going to chew up that housing demand. Now, the unknown is how much of the illegal immigrants are going to be deported. That's going to open up a lot of housing. If you had 20 million or 15 million, whatever that number is, no one knows for sure. You have 20 million housing units open up, apartments and houses and everything. That may do some supply shock and bring house prices down. That could have a big impact on house prices. So that's kind of another wild card, but the markets aren't betting on that. They're just focused in on the tariffs. So the local market here, everyone talks about the national housing market, which there is no such thing. So we'll just kind of compare the Twin Cities. We're not as bubbly as like Florida and Texas right now. So if we go back to 2006, this is kind of the housing bubble, the run-up, the crash. This is 2007. Our inventory started climbing back in 2006. We had a lot of investment come in, and just a lot of small-time operators pumped the local market with new housing and subdivisions. And then all of a sudden, the market kind of steamed off. So we peaked at about 111,000 listings that were on the MLS, not to mention the off the MLS listings. And then we had to chew that up over time. So the official market crash was somewhere in 2007, and then we had to slowly dwindle that inventory. And then by 2013, we had bottomed out for the number of housing units, and then everyone thought we were going back into the housing crash again because they speculated house prices started bottoming out and started coming up. So 2015, we were going to enter that housing crash again, and it didn't happen. The rates stayed low, and then 2023, people started pulling their houses off the market here because people are locked in. Now we are coming up on supply, but that supply isn't really added new supply. That's those are new listings. I'm sorry. Here's the homes for sale. So 34,000 is the homes for sale back in 2008, and then now we're at 8,700. So 3 times difference. We should be somewhere around that 15 to 20,000 with the population increase we have here. So the pending sales is where that supply is picking up. You can see we peaked here in pending sales, 69,000, and we're down to 45,000. Closed sales, similar. Days on market is slightly increasing to 45. Months supply, 2.3 months supply. Historically, we would say 4 to 5 months is a balanced market. And the reason we would say 4 to 5 months is it takes you 4 to 5 months to build a new house. So as quickly as you can build a new house and bring it to market, and then that sells, that's a balanced market. That's not true anymore with all the new regulations, getting zoning approvals, getting buildable lots, and then all the new building codes. You're probably looking at closer to 6 months building time. But the market's used to these 2-3 month supply. So anytime we go over like 2 or 3 months, it feels like it's a slow market when it's not. Back here we were 10 months. That bottomed out. We were actually over 12 months supply at one point, but it was a monthly supply. So then they averaged it out. Sales price is still increasing. Percent of original sales price, we're still at 100% of original sales price. We were at like 101, 102. Way back in 2009, they were getting like 93%, 92%. So if you're going in much more than 10% off original sales price on average, you're kind of outperforming the market. Now, some houses are overpriced to begin with, so if you're making a disrespectful offer, is what they call it, it doesn't matter. It's what is the value of the house, because the list price can be irrelevant to the value of the house. So just because you get something for 10-20% off doesn't mean that house is any more of a deal if it's 10-20% overpriced to begin with. So you got to just look at the market. If you're into the what you're buying as a single family for owner occupant, or if you're an investor, it has to do with your rate of return, not what you get off the list price. That's you're benchmarking off of something that's not real, so you can't measure against that. Percent of list price, average list price. That was original list price. The average is last list price is 100%, and this one went up to 103. Showings depending, 10 showings, 11 showings. For a while we were at 14 showings. This was kind of in the height of the market when you would have just these open houses. You'd have stacked up showings. The showings have dropped off quite a bit. Here's the average, 14 showings. And then the average showing per listing is 4.9 as of December. And then it had peaked right around 8 showings per listing on average. So that's our market. If you start looking at YouTube, we're heading into how rates higher for longer. I don't think that's going to play out. If you watch YouTube, we're going to get into another housing market crash. I don't believe that's going to happen based on housing inventory and the ability to build homes and the demographics coming up with the millennials and the Gen Y entering the workforce, forming households. We got to build more houses for that market segment, and unfortunately the houses we built are the higher end, and we need more of the entry level built, so there's much more pressure on that entry level. And in most states, I know in Minnesota, it is illegal to build that starter home now. You cannot build it because of the building codes and because of the zoning regulations and access to water and sewer. They have made starter homes illegal. It's too costly. You're going to spend 30 grand just on building permits just to get your house out of the ground here in Minnesota. And that's a tax. That's not safety anymore. That left the safety realm of what the building codes were intended for. So now we're into how many manufacturers can put their products into these building codes so they can create profits for their business versus is it truly safety that is needed. The electric code and plumbing code is riddled with that. You put in these arc fault breakers. How much safety for the amount of cost do you gain from that? It's such diminishing return, but huge profits for these manufacturers. So you run in from used to be $2,000 to put in your swap out a panel box. Now we're over $5,000 to swap out the same panel box just because of these new codes, and really no gain in safety. So there's those things that add to housing costs. So we still have a serious problem with providing that housing to the entry-level market, which is desperately needed. I do have hope that with some of the DOGE regulations, that some of that can get stripped out of there and regulated. I know some cities and municipalities are experimenting with zoning, saying up to 4 units on a single, if you're zoned R1 single family, you can go up to 4 units. So that allows some of these ADUs. And that provides a roof over someone's head. That's a good start. But long term, that's not where people want to live. They're going to want the traditional house, and we can provide it if we just open up some land and reduce these regulations and these building permit costs and these the red tape to get housing produced. Just let the builders build, and we can create affordable housing. But the policy is they call it smart growth, so they want to contain the developed city. Not all cities have smart growth. In the Twin Cities, we do. We have a group called the Met Council, and that's unelected. It's appointed by the governor to run that. The Met Council, they run the transit, the busing, and then now they have light rail, and then they have the urban, the MUSA line, the urban sprawl is what they're concerned about. So they restrict the amount of land that can be built on with water and sewer, and then they limit to what can be built with well and septic. Where you get into Texas and you can pretty much do private septic for a community. You're right, you can have a neighborhood on one shared septic system. They can build their own infrastructure within that community. In the Twin Cities, we have to tie it all into the same infrastructure, and then they slow the rate of growth down, increase the property prices. That's why it's $300,000 just to buy a lot to build on. So a lot of these affordable homes in Minnesota, you can go, if you're a first-time home buyer, you want to buy a house for $300,000, right? That's kind of stretched, maybe especially with these rates. The problem is that house is worth more as an empty lot than it is a house. So that chews up even more of that starter home product. So a lot of these homes on those inner ring suburbs, you get the Edina, the Minnetonkas, Plymouths, you'll get a lot of these tear downs. They'll knock down these 1950s homes that are on these nice large lots in great locations, and they'll build a $2 million house, right? They'll go buy that lot for 300, 350, up to 400, and they'll knock it down, build a nice house. So a lot of that starter home product is being demolished to build these bigger homes. So that puts even more of a demand on these starter homes. So that's the challenges in the market today. And that's kind of my predictions for going into 2025. My strategy is when I buy rentals, I want to buy these starter homes and provide housing. It's rental housing. I know people want to be able to own the home, but unfortunately it's illegal to build more of that product. But I can go in there and fix up these homes and rent them out and keep that market that's needed more and more housing, and that's a good investment for me long term. And these starter homes, that these younger kids can move into them. So that's a strategy for investing that I think would work well in certain markets. There's no uniform market across the United States, so it doesn't work in every market, but certainly in the smart growth cities, it does. So, and then regarding the California wildfires, I'm speechless. I have no idea how you get something so mismanaged and so incompetent. It looks intentional to me. I look at the photos and I say that had to be planned. Incompetence can't be run at that level. Just a systematic failure so egregious like that. And I look at the photos and it's just mind-boggling. And I don't know what their homeowners insurance is going to do, but I know homeowners insurance was struggling to meet California's requirement. They had to keep rates a certain price, so a lot of insurance companies backed out. So I think a lot of these homeowners are without insurance or they're on the California state pool. And I don't know how that's going to play out, but I'm going to guess that a lot of people are going to be left homeless or lost. They'll have their land value, but they'll probably have a mortgage on that and walk away. So these banks will end up on it, and I bet you the assessors won't be quick to tax that more at land value. So, Schwayne just sent me a $300,000 lot in Minnetonka. Yes, let's build. So, so the ratio on what Schwayne is talking about, there's a lot for $300,000 in a community here, and if you can buy a starter home for $300,000 in that community, theoretically you're below land value. So where do you start fixing them up? But the banks, it's not always true, but they used to want to see like a 4 ratio. So if you bought a house for $300,000, the lenders would want to see you at about $1.2 million or more. That changes a little bit. Some banks get more comfortable. You go buy a lot on the Lake Minnetonka. You'll buy a $1.5–2 million tear down, and then it doesn't matter. You don't have to throw up a $4 million house. You can throw up a $2 million house. The bank's going to bank it on the value of that land. So, but the traditional ratio was 4 times. And so if you're buying a lot for about $300,000 in an infill lot, you're probably going to end up having to build somewhere between 1 and 1.4 million to make the numbers work, to make it bankable. So that's what I got for today. Does anyone have any questions before I sign off here? There we go. Yeah, I'm going to sign off, get some work done this afternoon. That project, that rental that I had that got trashed, I rented it to 2 people, and they moved at least 7 in. I'm on the tail end of that. I got to make some tile repair in the bathroom, and now I find that the faucet's leaking, so I got to repair a gasket on that one. But I'm coming to the tail end, so hopefully get that ready for the spring market here. So I sat this winter, which has been a rough winter for me with 2 vacancies. And just it's a tough time to rent in Minnesota when you're sub-zero temperatures. So got to get through February, and then the March market will start to pick up. So we'll see housing inventory, the new listings start coming to the market right after the Super Bowl. That's when our spring market starts to kick in. So that's all I got for today. I will check in later. Shoot me a message if you got any questions, and we'll chat later. All right, thanks. Take care, Schwayne.